So I did not grow up wanting to be an investor. Nobody in my family had a lot of money. We didn't have an investment portfolio. My parents didn't really own any stocks. My dad sold textiles, and my mom stayed at home, then went back to college. We were a very educationally based family, but didn't have a lot of money. I was a good student, went off to University of Michigan, studied political science and economics. Was really fascinated by the combination of those two things, which led me to consider law school. Graduated from Michigan, went on to Harvard Law School. Really enjoyed learning the law, working at law firms during the summer. And it was really that transition from thinking about the economics background of this country and how economies and companies work, and then beginning to work at a big law firm, that I began to think more about what makes a business valuable as opposed to what are the interesting legal things to work on. I graduated from Harvard Law in '91 alongside our president, who was a buddy and I played basketball with, but I don't really talk to anymore. And I went to a good corporate law firm where I practiced law for 3 years and passed the New York and New Jersey bar, did a bunch of tax litigation, and eventually a bunch of M&A work, and working for some of the big LBO investors and companies that were sort of on the cutting edge of capital markets and capital finance transactions. And it was there that I really began to think about what made companies valuable being a more interesting thing to do as a career than how to help them do transactions. And as I became interested in that and started thinking maybe the law wasn't the right path, I began to read all of the books about investing and really fell in love with the concept of investing in stocks and investing in companies. That led to leaving the law, and I got a job in the research department at Smith Barney, which was a mid-sized retail brokerage firm that got a lot bigger when they merged with Lehman. There was an army of brokers to feed with product, and our group was a particularly active group doing both quantitative work as well as bringing individual companies public, and then writing research on them, and also building model portfolios of growth stocks for our brokers to go out and sell. That allowed me both to really get a fundamental background in all the different styles of investing, quant, value, momentum, combined with the continued reading about all the great investors, really led me to the beginnings of what really is our philosophy here at RiverPark, which is to really try to combine the best of thoughtful research-driven long-term investing, the best of value aspects of investing, along with the best of growth, as opposed to choose one or the other, which is what it seemed most of our clients did. Within a couple of years of really a year and a half, 2 years of working at Smith Barney, I realized I'd really found my calling, and investing in companies was what I wanted to do with my career, but I really wasn't doing that as a sell-side analyst at a big brokerage firm that had a lot of different constituencies and a lot of different politics. So that really led me to realize that the next step was to go to a great investment firm and try to learn from somebody who was really buying and selling stocks and building portfolios, as opposed to being somebody who wrote about it. So that led to switching from Smith Barney to a job at Barron Capital. Ron Barron, who's built a big business with our help, and in those early years. Great long-term investor, research-driven investor, not into trading, a lot of the things that I was looking to pursue. I joined Barron in 1995 and really grew along with the growth of the firm. I started as a research analyst, pretty much covering everything we worked on at Barron, flying around the country, building models, which was not a big push for Barron at the time, but to really add a quantitative element to it, where we really looked at the company as a private investor or an LBO investor would look at a company, build out 5-year models, really disciplined cash flow models, earnings models, go visit everybody we invested in, go talk to every customer, competitor, board member, to really try to understand the long-term potential for that business. My job at Barron evolved. I was there for 11 years. It's where the core founders of RiverPark met and worked together. my job evolved from being sort of Ron's right-hand guy and chief research analyst to being a co-manager on our small cap fund, to running our the REIT portion of our growth and income fund, eventually to being the co-manager and then lead manager of a poorly timed but incredibly rich learning experience of launching a tech fund in March 1 of 2000, sort of the top of the dot-com bubble at the time, and the experience of running that fund and restructuring it after the co-manager quit and the fund was down a lot, and restructuring it and really sort of being at the front end of understanding the internet and technology and its impact on companies, but from a perspective of non-bubble, non-hyped valuation. We really fixed that fund, had some great returns that led to the launch of our large cap fund at Barron, which really was the precursor to what we think of as both the core franchise here at RiverPark, which is great long-term growth investing on the long-only side with the RiverPark Large Growth Fund, but also really combining all of our different skill sets in both small cap, large cap, but also the relative maturation of companies and the impacts of secular change on businesses to also carry a short book and businesses we're shorting and be able to manage both exposure, long and short, and then to have both of those core products, clients who want a great, thoughtful, research-driven, long-only fund is we're really proud to offer the RiverPark Large Growth Fund, which I manage, and for clients who want an even more involved fund where there's small caps, large caps, derivatives, the ability to use debt or equity, and the ability to short and run a balance sheet, which is the RiverPark Long Short Opportunity Fund. We are research-driven, long-term investors in growth businesses, but we have a strict value orientation. Our goal is to find great growth companies that have the potential to be materially bigger in the future. We then wait patiently to invest in them only if we can do so at great prices. Our strategy combines what to us is the best of the value and growth approaches to long-term investing and is grounded in two core beliefs. The first is that the long-term change in the earnings power of a company is the primary determinant of its future value. Second, that a great company only becomes a great investment if it is bought and eventually sold at a great price. We believe these two inputs to be as significant and relevant today as they have been throughout our careers. To us, nothing in the increased volatility of the markets, the expanded focus on global macro, geopolitical events, the explosion of the use of ETFs or fast trading, have in any way diminished the importance of combining growth and value when investing in stocks for the long term. We believe that if we successfully execute on both aspects of this strategy, we will build portfolios that will produce great long-term investment returns for our investors, while also outperforming relevant benchmarks in both up and down markets. Our portfolio and our research are focused on growth stocks. We look for companies who have the potential for their earnings to rise dramatically. We have concluded that there are few distinct factors that drive this kind of expansion or collapse in a company's earnings over time. The first is that secular changes in society provide the primary backdrop for the creation and destruction of business opportunities over time. Today, such changes that are reflected in our portfolio are things like mobile computing, the internet, globalization, the aging of the baby boomer, and electronic payments. We believe these are much more powerful forces than the latest economic headlines, deals over sovereign debt, or anything else. Second, companies with great business models, competitive advantage, and barriers to entry are the ones most able to take advantage of these opportunities and avoid the risk that these changes provide. We look for businesses with high return on capital, low levels of debt, strong and growing free cash flow, and pricing power. Finally, and maybe most importantly, a high-quality management team that is able to execute and adapt is often the most important determinant of whether a business achieves its potential that is created by a secular change on a great business model. It is on these three factors that we spend the vast majority of our time and research effort. with a time horizon that we measure in years. If we then apply a value orientation when we buy these businesses, we believe we should come out with a high-quality portfolio that is also attractively priced, and our stocks will achieve the success that the businesses achieve over time.